Good morning. We will start the presentation. So today we have two parts. The first one is regarding the union budget, which was presented by our finance minister last week in parliament. Then we will see the current market scenario presentation. After that, we will see the recommendations. Then if we have time, then we will go for question and answer. First, let us start with union budget review. If you see the budget, this time our finance minister speech was very short. The budget was complete. Budget speech was completed within short period of time relative to previous budget. And in this budget, if you see, we don't find any major policy changes for the government. For the last 2 years, what government is doing is that because of COVID, government is continuously borrowing heavily and spending money in the economy for revival of the economy. Basically, this policy is called Keynesian policy. Why the name is called Keynesian is that during 1930s, there was an economist called John Maynard Keynes. He's an UK-based economist. At that time, when Great Depression came, he said that during depression time, government should not look for deficit. Instead, they should spend money heavily to revive the economy, and they should not see the fiscal deficit because government is the only who can spend money during the depression time. So that is why it is called Keynesian policy. And the same thing is followed by our government now. So for the last 2 years when COVID came, there was lockdown, economy came to down, and almost the entire world suffered. So at that time, the government, only option available with the government to revive the economy, to run the economy is that government can only spend the money by borrowing heavily. So the last 2 years back, they started. Last year also, they continued the same policy, and this year also they have continued the same one. That is, government is borrowing heavily and spending money without looking into fiscal deficit. So fiscal deficit will continue to be very high, and fiscal consolidation will get postponed further. The other big highlights in this budget was that major tax was untouched this time. Either it is a direct tax or indirect tax, nothing was changed. Many middle class family were expecting that because of polls in 5 states, income tax, some changes, some tinkering will happen in income tax slabs so that middle class may get benefit, but nothing came in that. So that was little surprising. As well as there was no populist measure even for rural India or for agriculturalists. Generally during poll time, government used to announce some populist measure, but that was also missing in this budget. So overall, it is a status quo policy budget where government is continuing what it was said last year, and same will be continued this year. One big surprise in this budget was that budget estimates were very conservative. Government generally, historically, if you see in Indian budgets, then government used to put a high tax revenue collection and thereby bringing down the deficit numbers. But this thing was not there. The estimates were extremely conservative. Most probably, government may stick to its budget deficit numbers in coming year. So one big highlight of the budget was every newspaper or any media channel was telling the only point where everyone was telling is about the capital expenditure. That government has hiked the capital expenditure by 35% in coming year. So this is the only highlight for the budget where the capex has been hiked very sharply, and this is the capex spending by the government for the last 10 years. If you see that it has been gradually going up, but in the last 3 years, if you see, it has gone up very sharply. In 2019-20, it was around 3.3 lakh crore. almost more than double for in next year. Next year, government is projecting 7.5 lakh crore, which is a very sharp hike when compared to previous year, as well as when you compare to previous 3-4 years. If you see that there was a sharp hike in capital expenditure, even though this figure is debatable because some of the expenses has been included in this capital expenditure figure. For example, in 21-22 in revised estimates, government says that the capex is done is 6 lakh crore. In that, almost 50,000 crores, the debt of Air India has to be repaid by the government. So the debt of Air India has been included. Repayment of debt of Air India has been included in the capex. So the repayment of debt is not a capex, but government has included that in the capital expenditure for next year. That is 22-23. If you see that out of 7.5 lakh crore, 50,000 crores they are going to give to BSNL. So last year it was Air India, and last year means I am telling about current year 21-22, and next year it is BSNL. So 50,000 crores goes in that. Like that, many some accounting inclusions were there, where extra budgetary expenses and all included in this capex. Even after that, we see that even compared to 2 years, 3 years back, the capex has been has gone up very sharply in current year as well as for the next year. It's a very conservative budget. I told in the beginning speech that it's a very conservative budget. The government tax collection, net tax revenue, they are estimating just a 6% higher. That is for FY22. For current year, the total tax collection will be 20.7 lakh crore. For FY23, that is next year, the BE is budget estimates, RE is the revised estimates. So for FY23 budget estimates, they are estimating around 22 lakh crore of revenue. The net tax revenue to be 22 lakh crore when compared to 20.7 lakh crore in current year, that is FY22. So just 6% higher income they are expecting through tax revenue. It's a very conservative estimate, because in the past what used to happen is that government used to project a tax revenue of 15 to 20% high, but end up with only 10% higher tax collection. Thereby fiscal deficit used to go up very sharply because of lower tax revenues. But this time, because of conservative estimates, net tax revenue is expected to go up by just 6%. The second important thing is that the divestment receipts. Government used to sell shares it owns in the company, and it is shown as a divestment receipts. And for current year, it is 78,000 they are expecting. Actually, initial budget estimates was 1.75 lakh crore, but that has been brought down to 78,000 crore in revised estimates. For next year, they are expecting 65,000 crores only they are expecting for next year. It is also very conservative because there is a possibility of selling container corporation and small companies like BEML, whereas BPCL it may be little difficult. Suppose if crude oil prices keeps on going up, then BPCL no one else will come and buy it. Even if you see now, for the last 3 months, petrol prices and diesel prices were untouched because of election coming. Even though crude oil prices have gone up very sharply, if for some instance due to some geopolitical tension, crude oil goes up to $120, $130, means the government cannot hike petrol and diesel beyond a point. At that time, they try to keep the petrol and diesel prices lower, which means that BPC companies, oil marketing companies like BPCL, IOC, SPCL, they will continue to make loss, at least in the interim period, because they have to bear the higher charges. And if a private person comes, means they cannot continue to give subsidized petrol to public. Since it is a government company, BPCL, HPCL and IOC, they are continue to sell at a lower rate in spite of higher crude oil prices. So BPCL may be difficult to divest next year if crude oil prices goes up and stays that level. But companies like Container Corporation and all, some groups like Adani, they may take loan from the bank and they may buy that company. But BPCL may be difficult. But in spite of that, disinvestment target kept has been very low, just 65,000 only they have targeting for next year. It's basically a very conservative budget. They can easily achieve the fiscal deficit, and they are unlikely to exceed the fiscal deficit target next year. The one big point where I always used to have concern is the fiscal deficit, because fiscal deficit is nothing but the government revenue minus government expenditure in a year. Government used to get revenue through tax collections, through PSU divestments, through other income like RBA dividend, and all they used to get revenue, and they have a lot of spending, giving salaries, giving pensions, giving you food subsidy, like that. Lot of expenses are there. So overall, government income minus government expenditure is the deficit, and if it comes in GDP terms, generally it is shown in terms of GDP terms. Actual figures generally used to be very high, absolute figure used to be very high. That is why they always show it in terms of GDP, overall GDP size. Then only the figure won't look alarming. And if you see that this is the GDP, this is the fiscal deficit chart for the last 30 years. And if you see that fiscal deficit for India generally used to be extremely high. And if you see particularly in the last 3 years, the combined deficit was almost 10%. In a FY 20, if you see that the combined deficit of central and state has almost 14%. The blue, dark blue is of the union fiscal deficit, that is the central government. The light color, gray color is the state deficit. In a FY 20, the deficit touched almost 14% of GDP. That is understandable, because government lockdown was there for many months, and government has to distribute free rice and pulses to the poor and needy people. That is why it is acceptable. But for the next year, it is almost more than 10%. And for coming year, it is expected that the deficit will be around near to 10%. So when we had this type of fiscal deficit is that during 1999 and 2002, at that time, we had the similar type of very high deficit, the very high deficit. 99, 2000, 2001 and 2002, we had a very high deficit. And during 1990s, early 1990s, when Indian economy was not opened at that time we had a very high deficit. So almost we have reached to that stage. And the worrying point is that the fiscal deficit continues to be extremely high. And if some big issue happens, then government may find it too difficult to service the debt they are taking for the fiscal deficit. So the only period where India had a very comfortable fiscal deficit in the past in the Indian history was between 2004 to 8. And if you see that the deficit both for center and state continuously fell from more than around 9% to almost 4%. So only during that period only we had a golden period of our macro economy doing well, and else all other period it was either stable or extremely bad. Now we are having a very bad situation of very high fiscal deficit. Generally, government used to tell the fiscal deficit in terms of GDP, because that figure won't be look alarming. But if you see that if it is expressed in terms of actual figures, means it always looks alarming, and everybody will become very bearish if they look bearish on India if they look that figure. And this is the figure for the last 8 years I have put it, including next year. So if you see that in FY 14 to 18, the fiscal deficit was around 5 lakh crore, 5 to 6 lakh crore. That is, government used to borrow 6 lakh crore to finance the deficit. And in terms of GDP, it has come down 4.5, 4.1, 3.9, 3.5, then 3.4. Because GDP used to grow in our country, India is a growing economy, and GDP used to grow. That is why the fiscal deficit has continuously come down in spite of higher borrowings. But FY 20 onwards, the fiscal deficit again started going up very sharply. FY 20, if you see that, it is 7.6 lakh crore, that is 3.8% of GDP. FY 21, that is during the COVID period, the fiscal deficit was 18 lakh crore, almost more than 150% hike in fiscal deficit, 18 lakh crore. Then in the current year, it is 15.9. The next year, again, it is expected to be 16.6. So what is actually happening is that government has almost borrowing 50 lakh crore like last year, current year, and next year to finance the deficit. Money never comes freely. You have to pay the interest for it. And even if you keep 7% interest for the government borrowing, 6.5 to 7% interest means almost you need 1 lakh crore excess revenue to finance the interest cost every 1 year. For example, for current year, government is borrowing almost 16 lakh crore. That means to pay interest for this 15.9 lakh crore, 1 lakh crore excess needed for to give interest for current year interest alone, for current year borrowing interest alone. So next year you need 1 lakh crore extra. Again, in the coming year, you need 2 lakh crore extra because for next year also it is projected to be 16.6 lakh crore deficit. So the next year you need 2 lakh crore. Like that, cumulatively, the interest cost will keep on going up. So the fiscal deficit burden is a never-ending burden for anyone in our country. At some point of time, someone has to bear the cost. Every government used to borrow heavily. It's not only the central government, state government also borrowing heavily because they used to borrow 10 year, 20 year like that. If I borrow money from a bank means I am the person who has to repay the money to the bank. Suppose if a government borrow means they borrow by 10-year bond, 20-year bond like that. So after 10 years, no one knows who will be the PM. No one knows which government will be there. And the burden will go for them to pay the interest for previous government's interest and deficit. So like that, governments will never hesitate to borrow because it is not the government which is answerable for the debt they are taking. It is the future government is answerable for the debt they are taking now. Like that, the time is keep on going, and at some point of time, somebody has to bear the burden. And this is the borrowing chart because fiscal deficit for next year, 22 lakh crore government is earning through tax revenues, and they are spending almost 39 lakh crore. They are spending it. So the balance 17 lakh crore they have to get it from somewhere. Majority of it will come from borrowing. A part of the money will come from a divestment and through RBI dividend like that. But majority of the money it has to be come from borrowing only. And if you see the chart of how much government is borrowing, gross borrowing is there, net borrowing is there. Gross borrowing is the money they are borrowing. A part of the government bond will get redeemed this year, and we have to see the net borrowing figure. And if you see in 2018-19, the net borrowing was 4.2 lakh crore, 1920 4.7, then 2021, where actually the COVID hit, it was a 10 lakh crore government borrowed from market borrowings. Then 21-22, 7.6 borrowings actually came down in current year because of higher tax collection. And again, next year, they are expecting 11 lakh crore of market borrowing. They are expecting for next year. So how they will borrow this money? If you see, this is the overall, this is the slide taken from a budget document. And if you see that totally government is borrowing 16.6 lakh crore next year. So the market borrowing will be 11.5 lakh crore. Securities against small savings. So whatever money we are putting in post office, actually government is borrowing that money, even though it it has been said as a small savings. Actually, government is borrowing money from that because the government has to pay interest for that. Almost 4 lakh crore is borrowed from small savings. All this NSS, the other things we put money in post office. It's a small savings. Even though it is called small savings, government is borrowing money from that, and provident funds 20,000 crores they are borrowing. Then other external debt 19,000 crores. So this is the overall borrowing. How government is managing the 16.6 lakh crore of deficit is that. the government is borrowing through various sources. Market borrowing 11 crore, the small savings borrowing 4.25, the state provident fund 20,000. Like that, overall government is borrowing 16.6 lakh crore next year. And as I said previously, more borrowing means more interest expenses. So whatever government borrows, it has to pay interest for that. And if you see that the percentage of interest expenses on overall revenue receipts, it keeps on going up. Revenue receipts is next year it is projected to be 20 lakh crore, whereas the interest expense is 9.4 lakh crore. That is 42% of overall government revenue, that is tax revenue, is spent for giving interest alone, and this figure will keep on going up only because every year government is borrowing money and they have to pay interest for that, apart from additional older debt. So the interest expenses will keep on going up. FY21 the interest expense was 6.7, FY22 it was 8.1 lakh crore, and for next year it is 9.4 lakh crore. So the interest expense will keep on going up because of a very high deficit government is doing, and even though revenue is going up, majority of the money will go for expenses only, interest expenses. And as per the Kotak Economic Research estimates, the borrowing is not going to stop here. For the next 3 years also, the borrowing is going to be at a elevated level, more than 10 lakh crore for the next 3 years. This is the net borrowing and this is the gross borrowing figure. So the borrowing which was very stable between 2013 to till 2019, it is going up very sharply in the last 2 years, and in the next 3 years also the borrowing is expected to be very high. So whenever government borrows, what used to happen? Bond market reaction will be very negative. Bond yield will go up because when government borrows money means they when money is in demand from the government means naturally the interest rate will go up, and it is reflected in the bond market. And if you see that on the budget day there was a sharp spike in bond yields, but it has cooled down little bit after the RBI policy meet where they had a extreme dovish policy. That is why the bond yield has been temporarily cooled down. But if some geopolitical tension comes and a global market, if there is some tremors we see from the global markets means, then the bond market will again start reacting negatively. And this is the government debt and liabilities. And if you see the figure means, it will be extremely a mind-boggling figure. So the central government debt, this is the debt of the central government alone. We are not taking any state government debt. And one positive point is there in this slide that I will tell now. The overall internal debt and other liabilities of central government, that is our union government, is 147 lakh crore. It is the overall debt, internal debt and liabilities the government is having, central government alone is having. So among the overall debt of 152 lakh crore, internal debt is 147, the external debt is 4.69 lakh crore. The external debt is actually measured the actual debt taken rate, a foreign exchange rate taken at the time of debt. But if you see the debt at current exchange level means, it will come another 3 lakh crore, it will come. So by next year end, the expected overall debt will be around 55 lakh crore. If you see at the current foreign exchange rate, why we are taking a current foreign exchange rate means that suppose if government would have taken some 10 billion worth of external debt when rupee was around 50. Now it is rupee is around 75. So they have to pay 50% higher amount in rupee terms because rupee has depreciated. So if you take that figure means another 3 lakh crore extra will come in external figure. Overall debt will increase by 155. So the overall central government liability having is 152 lakh crore worth of liability central bank is having. The big positive what we can see is that more than 95% of our debt is internal debt. So the internal debt and liability constitute majority of our central government debt, whereas the external debt will have around 5% of overall debt. So that is the big positive India is having, in spite of very high debt levels we are having. We have only internal debt, external debt we don't have. Some of them who are in the market for the last 10 years, 15 years, they will be knowing that in 2011-12 period and all, the many European countries face the problem of very high debt level. Greece, Spain, Portugal, and all had a issue of servicing their debt level. Had a issue of debt servicing, that is payment of interest for their debt. Many European countries had. Why they had the problem is that these countries had majority of external debt only they had. They borrowed from other countries and they spent the money. And when economy slowed down, they did not have an ability to service that debt. But for India, fortunately, in spite of very high debt level, our majority of debt level is from internal only. Our external debt consists of only 5%, which is easily manageable when compared to other countries. So that is the big advantage we have in spite of very high debt level of central government, because the government has an power of printing money, and they can service the internal debt by printing more money. Whereas for external debt, you have to pay in dollar. You cannot print a dollar, but you have to pay in dollar. That power our government don't have. So that advantage India has in spite of very high debt level of combined central and state. And in the budget, if you see that where majority of the money is being spent, Food Corporation of India, the food subsidy given to Food Corporation of India is almost 145,000 crores government is giving. And investment is NHAI, which is basically for laying roads, 1.34 lakh crore. Then Manrega, 73,000 crore. Then PM Kisan, 68,000. Then food subsidy for centralized procurement, 60,000. Then Jal Jeevan, which is basically the pet project of our PM. When he came in the second term, the next 5 years, he said that he want to give drinking water connection to majority of the village areas and rural areas and towns, and for that 60,000 crores has been allotted. If you see that in that project, money has been continuously increased. For initially in FY20 it was 10,000, FY21 it was 10,000, 22 45,000, which is current year. For next year it is 60,000. Then other Pradhan Mantri Awas Yojana, which is for the subsidy given for affordable housing, is 48,000 crore. The National Education Mission 39, National Health Mission 37, Pradhan Mantri Gram Sadak Yojana, which is for rural areas road, 19,000. So if you see that the major hike in expenses has come from investment in NHAI, which is basically for putting roads. Almost double is that, 65,000 crore to 1,34,000 crore. Then this Jal Jeevan Mission, National Rural Drinking Water Scheme, 60,000 crore from 45,000 crore. All other schemes, there was not major hike. In fact, some of the scheme like Manrega and all, there has been a sharp drop in outlay. So the big theme for the next year for investment will basically in infra, because government is going to spend money in infrastructure. Actually, if for current year, when in last year budget, when government told that 6.8% of the fiscal deficit projected at 6.8%, it was projected. It was highly conservative. By the year end, they may end up with 6.4 or 6.5 level. But actually, what happened was that the actual revised deficit was 6.9, higher than 6.8. Actually, it was surprising to everyone. And I am also was very surprised, because government was continuously telling that the tax collection has been extremely good and it will reduce the overall fiscal deficit. Not only me, many economists also told that the fiscal deficit will come down. But to the surprise, the fiscal deficit was higher than projected last year. So the what is the culprit was the main culprit was the non-debt capital receipt which has pushed up the deficit, which is nothing but the PSU divestment, where the government missed by a vast margin. During budget last year, they said that they will collect 1.75 lakh crore, but actually they are ending up with collecting only 75,000 crore if LIC issue is get completed by March end. So that in that government almost 1 lakh crore was missing. That is the big culprit in the for the deficit to go up. The second one is that the expenditure has gone up by 0.5% of GDP. That is the second culprit. So the tax revenue was higher, but in spite of that, again the fiscal deficit was higher than the estimated at last year. One big portion was untouched in the budget is the income tax. The many middle class family was extremely unhappy with the budget. Many people I spoke with them, for basically middle class people, I spoke with them. They are very unhappy with the budget because no tax stops given for income taxpayer. So what I feel, why government did not touch the income tax was that already we all know that inflation is very high. Whatever product you are buying, the prices has gone up very sharply. So if income tax rebate has been given to middle class, means money will be in the hands of consumer. They will try to spend the money, and if they spend the money for buying consumption, means already the inflation is high. The demand will go up because of higher spending, and higher demand will push up the inflation further higher. So that is the reason why the government did not give any shops for consumption based recovery, because the consumption based recovery in economy is always inflationary. Instead of that, government want to spend more money on capex, so that the investment led recovery, if it comes, means it is relatively less. It is relatively less inflationary. If you see that in US, when COVID came, the US government gave money freely to the citizens of US, and that is the reason why, if you see that in US the inflation is going up very sharply, because money has been given directly to the citizens of the US people, and they have spent the money. That means they bought more goods, and which has pushed up the inflation very sharply. So what government has done in a one way is correct, where they want the investment-led recovery in economy rather than consumption-led recovery, so that inflation rise in inflation will be modest. If consumption-led recovery is there, means generally during this time when there is supply disruption is there due to COVID, consumption-led recovery will be very highly inflationary. And because of the budget, some of the sector where we are positive is that banks looks positive, capital goods looks positive, because many companies are coming up with the PLI scheme. They have to spend the money in capital goods. Then infra is positive, because government is going to spend a lot of money for laying roads and other infrastructure projects. So these are some of the sectors which look positive, whereas some of the sectors where negative impact will be there is the FMCG and discretionary consumption, because FMCG inflation is going up, whereas the consumption is not up to the mark, because government hasn't given any subs to improve the consumption. FMCG sector will remain in sideways, and even if you see that companies like Britannia and all hasn't moved anywhere in the last 4 years, the price has come what it was 4 years back. Similarly, Hindustan Unilever, the stock price is moving sideways. So FMCG company will continue to underperform in coming years, because the coming months, because the consumption is not going to pick up. Then the discretionary spending, the companies which are manufacturing air conditioners, which are manufacturing refrigerators, if you see that also will come down, because people don't have money to spend much. Only government is spending money in capex, whereas the citizens don't have money to spend much, and if interest rate goes up further, and EMI will start going up, thereby the discretionary consumption will have negative impact for the next 1 year. So the positive sectors are banks, capital goods, infra, while negative sectors will be FMCG and discretionary consumption. And one thing I noticed in the economy, in our economy, is that clearly we are seeing a K-shaped recovery in our economy. So what is meant by K-shaped recovery is that certain section of public will see a good recovery in their income, their business and all. Certain section will see the because of COVID disruption. Certain section will see a fall in their income, and many will lose job also. So the certain section will come down. Certain section will see uptrend in their standard of living. Some in IT sector, those who are working in IT sector, salary levels has gone up very sharply. They will see uptrend in their way of living life. Whereas tours, travels, and and those who are impacted by COVID, they are seeing downturn in their earnings, and this section will see downturn. So this is called K-shaped recovery. And if you see in our economy, we are clearly seeing that IT sector is doing very well. And even now, many companies are complaining that they are not getting enough staff to meet their demand. And definitely, IT sector is doing well. And definitely, the employees working in IT sector, they are spending a lot of money because the salary level has gone up. Whereas those on the middle income and lower income group, those who are doing small businesses, they are suffering a lot because of COVID disruption, and they will continue to face uncertainty in coming months. So we are seeing the K-shaped recovery. For example, when I speak to a barber owner, he was very upset. He is telling that my income has come down sharply post COVID because of lockdown. I could not able to meet my expenses like that. He is crying, and tour operators, they are crying, and school bus operators, they have lost a lot of money because of COVID. So these people, it will take 2 years, 3 years for them to stabilize. So these are the people which are seeing downturn in their life, whereas the IT guys are seeing upturn in their life. So the economy is divided, where one person is seeing downturn, the other person is seeing upturn. That is the typical K-shaped recovery in our economy. And if you see that some of the businesses are affected because of raw material prices, steep increase in raw material prices. 1 week back, I went to Madurai. I went to my native place. In that, I talked with a sari business owner. He manufactures a textile. He manufactures a cotton sari and sells. He's a manufacturer and gives to shops like very big shops like Pothys, Kumaran Textiles, like that. And he is generally used to be a very optimistic person, and he's a risk taker. He himself was very upset. He says that the cotton prices has gone up by 40%, 50%. The dyes which gives color to the sari, that has gone up by 30%, 40%. Everything price, every raw material price has gone up by 30 to 50%. Whereas I could not be able to increase the price of my sari because shop owners, they generally hesitate to give price hike to them. They always take 6 months to 1 year hike. And he says that without profit only I am doing business now. Sometimes I have to make loss also. Like that he is saying. So those who have got affected by raw material, a steep increase in raw material prices, that business owners, they are affected a lot. So overall, our view for the budget is that it's a status quo budget. Government has taken risk to borrow further and spend without bothering a fiscal deficit. Right now, government has less option because they want the economy to do well in next 2 years, because in 2024 election will come. At least before that, they have to push up the economy to normal level, because by that time the ground level economy will reflect on voting pattern. So they have no option. If they spend now only, it will get reflected in the next 1 year, 2 year. That is why they have no option but to remain keen by to remain following Keynesian, that is spending more by borrowing. So one big risk government is taking now is that suppose for some issues economy fails to revive sharply and oil prices at an elevated level, that is more than $100, and continue to stay around that for 1 year, 2 year, then if tax collection falters because of lower growth in economy, there is a big risk of stagflation. That is, economy will remain there without much growth, whereas inflation will keep on going up because excess government borrowing will always lead to inflation. If economy grows well, means we don't have any issues. If economy stagnates because of some unknown reasons, then government will definitely face the problem in the next 1 to 2 years. That risk government has taken. We have to see how it pans out. And next 1 year, we are going to see huge volatility, not only in our market, in the global market, because US Fed is going to hike rates and commodity prices are very elevated. And because of that, next 1 year, we are going to see huge volatility in global market as well as in our market. Now we will come to current market scenario. If you see that the market has been moving sideways for the last 2 months, 3 months, there has been, if you see in the last 5 months, since September, the index is almost at the same level where it is now. So for the last 5 months, the return has been almost zero. If foreign portfolio investors, they are continuously selling in our market. Yesterday, it was a buy figure, but part of it is maybe two block deals has happened yesterday. One is in TVS Motor and another one is in the Policy Bazaar, where promoters have sold their shares. A part of that would have been bought by foreign institutions. That is why yesterday a foreign institution figure has been net buy figure. If we leave aside that, most probably yesterday also would have they would have sold shares, because the shares yesterday fell mainly was IT shares and companies like HDFC Bank, Kotak, the HDFC like that, where FIs have significant holdings. These are the shares which fell very sharply yesterday. So foreign portfolio investors, they have been continuously selling in our market, and global markets also very weak. They are adjusting to US Fed rate hike. US Fed rate hike is likely to happen in the month of March, and mostly, and if you see that before the actual rate hike comes, market will tend to discount the rate hike news. And the most important thing is that oil prices is going up very sharply. Yesterday, because of geopolitical tension, yesterday oil price went up by $4, and today morning when I saw that Brent crude was almost $94, extremely high price for India to afford it, and it will have an impact on our economy. And if you see the Nifty and Sensex, it is a minus 2%, and mid and small cap, it is almost 4.4% minus. So all the major indices fell very sharply in the last 1 month. And we are getting Q3 results, and by Monday, the overall Q3 results will be ended. And if you see the overall result pattern, the overall Q3 results were mixed. And so banks and IT posted good results. Banks, especially banks, results were extremely good. And IT companies also posted one of the best results in the last many years. Metals, steel companies, if you take metals, steel company, year on year, there was increase in profit, whereas quarter on quarter, there was a dip in profit, whereas the base metal companies like Hindalco, Nalco, they posted good results. Cement, they posted below expected results. The volume growth was negative for many cement companies. Similarly, the profit has come down sharply, mainly because of coking coal price going up very sharply. So, cement company posted below expected results. And all other consumer-oriented companies, FMCG companies, there was a huge pressure on margin. The volume growth was muted, 1 to 2% only volume growth was there, whereas the margin pressure, there is a huge margin pressure in almost all consumer oriented and FMCG companies. And this is not going to end here, and it will take another 1 to 2 quarters for margin pressure to go to get eased. It's not a 1 quarter phenomenon, because whenever the cycle turns, the price will keep on going up. The raw material prices, it won't come to the previous level in 1 quarter or two quarter. Generally, it will take the 3-4 quarters. So at least for the next 1 to 2 quarters, we are going to see the margin pressure in consumer oriented and FMCG companies. And if you see the textile space, it's a very interesting in this textile space. Some companies have posted record profits, especially in the spinning mills. Those who are operating in spinning mills, they have posted record profits. Whatever profits they have made, cumulatively made in the last 10 years, they have posted profit in a single year in current year. And some of the companies like Indocount, Wellspun, where they sell the home furnishings in markets like US, they have their results were not good, and and next quarter results, these companies, unlike results also, because the commentary from this company is that next quarter also it will not be good. So the textile companies is seeing mixed results, where spinning mill companies are posting record profits, whereas the foam furnishing companies, export oriented foam furnishing companies, their results were not good. So overall, if you see the Q3 results, what I will say is that only banks and IT posted good results, whereas the all other sectors, the results were not good. Metals is good. Banks, IT, metals is overall good. All other sectors, the results were not good. Maybe 1 or 2 here and there, exception cases, the result might have come good. But overall, it's a very mixed quarter, and we are expecting that next quarter also will be similar to that what we have seen in Q3 results. And if you compile the companies of 1,138 companies, where this data, I used to take it from business standard paper where they will use to put it. And if you see that the sales growth has been very good, mainly because of a raw material inflation. And if you see that the sales has gone up by 27%, whereas the profit has gone up by 33%. Actually, the profit main contributor for higher profit is by banks and metals. If you leave aside these two sectors, and if I would have compiled the results, means sales will be higher, profit will be lower than sales growth. But since I have included all the financials also and metals also, the overall profit figure has gone up better than the sales. When last year it was just 1.5% growth and profit was 75%. But this year profit has gone up mainly because of banking and metals, and to some extent IT sector. The next event everyone closely watching is the US Fed rate hike. Actually, on 14th, one emergency meeting, that is on 14th next week, when US Fed has put on an emergency meeting, there was rumor going around in the market that US Fed will hike rate on February 14th. But what I am hearing is that it is this type of meeting used to happen, has happened previously also. But rate hike unlikely to happen on February 14th, which is an unscheduled emergency meeting. They have put the meeting to discuss some other issues. So it is unlikely, rate hike unlikely to happen on February 14th. The actual schedule for the meeting is on March 16th. That is next month. And Fed, it is expected that Fed will hike interest rate either 25 basis point or 50 basis point. And there is a consensus in the market is that by July, Fed would have hiked by full 1% interest rate in US. So because of this expectation, the equities and bond markets already started discounting in US. We are seeing that Nasdaq has almost corrected more than 15% from the peak, and Dow Jones also has corrected. And bond markets, which used to be around for 10-year US bond, which used to be around 1.5%, now it has crossed to 2%. So the interest rate hike in the March 16th meeting is certain, and we are going to see it. But before March 16th, the market will discount the interest rate hike. So we are going to see the volatility in the market. Both equities and bond market will adjust to the interest rate hike before March 16. And market what it is seeing is that we are seeing that lot of loss making companies both in US as well as India. If you see that they are seeing sharp fall in their share price. One of the reason is that till now US Fed had a very linear balance sheet. They used to do quantitative easing by buying bonds, by injecting liquidity in the market. That is going to stop from this month onwards, and from next month onwards, what it is going to happen is that they are going they are going to shrink the balance sheet. That means they are going to suck liquidity from the system. So whenever the liquidity is getting sucked from the system, is that naturally interest rate will go up, then liquidity will become scarce, which means that all the loss making companies which enjoyed huge valuation in the last 1 year, that party is started to come to an end. And most of them are watching more than rate hike how fast Fed will shrink his balance sheet. That is the thing where most of them are closely watching. And this is the balance sheet of US Fed, where if you see that it was just 1 trillion in 2000 decade. In up to 2008, it was around less than 1 trillion. When because of the global financial crisis, they made some quantitative easing. It went to 2 trillion, the balance sheet size. Then they will continue with their quantitative easing, which went to 3 trillion. And by 2014, when economy started stabilizing, they stopped the quantitative easing. And if you see that the balance sheet size was kept stable for 4 years, 2014 to 18. And then they sucked some liquidity from the system because US economy was doing well, and it started balance sheet size started coming down. But in 2020, when COVID came, they simply expanded the balance sheet very sharply from almost 4 trillion to 7 trillion. And then because of continuous quantitative easing they did in the last 1.5 years, almost 8.8 trillion, the US balance sheet size has expanded. Now, what Fitch says is that US rating company Fitch says is that the US balance sheet is very expanded related to its economy, and US Fed will start shrinking it. And US Fed also has said that they will start shrinking the balance sheet. And as per Fitch rating company, Fitch estimate is that by 2024, we are now in 2022. In next 2 years, the balance sheet size will come to 6.5 level. That is the level which was seen in 2020. That means whatever the quantitative easing did in the last 1.5 years, they will gradually suck that money from the system, and balance sheet will start shrinking. That is what the rating agency Fitch says. So once the balance sheet starts shrinking, means then liquidity will become scarce, and the companies, the loss-making companies, and some of the startups which were getting a huge financial support from PE players and all, that may come to an end. And this is the inflation data which came day before yesterday. It came to 7.5. The expected inflation rate in US was 7.2, and it is almost the 40-year high. What it was seen in 1982, the same type of inflation came now. Very sharp increase. So one of the reason why inflation is going up very sharply in US and Europe when compared to other countries is that US gave money to its citizens freely, and they asked them to spend. So whenever money is given freely to all means naturally they will spend money in the economy where there is already scarcity of goods due to COVID disruption. When everybody has money and everybody buys goods means naturally the inflation will come in. That is what happened. And initially US Fed said that US Fed told that the inflation is transitory and it will end soon. Now they have removed the word transitory. It means that inflation is going to be sticky for some more time. That is why US Fed is increasing the interest rate as well as shrinking the balance sheet. They want to suck out the liquidity from the system. And this is the US bond yield. It has touched almost 2%, which we have seen in 2019. And if you see that there has been a sharp fall in US bond yield because of the quantitative easing they did during the during the COVID time. So one big headwind for India as well as the countries which are importing oil is the crude oil. It is marching towards $100. Since the petrol price is not touched for the last 3 months due to political reason in our country, we are not feeling it. Actually, if petrol price has been moving in tandem with crude oil means at least a 10 to 15% rise would have happened in petrol prices now. And yesterday, this is the chart I took it a day before yesterday. Yesterday, it has gone up to $94. And there is a huge geopolitical tension news is coming. And if for some reason this geopolitical tension turns into reality means definitely crude oil will go to $120, $130. It won't sustain that, but at least in near term, it will go there, and which will be a big negative for our country. If crude oil goes to $120, $130 means somebody has to, it is an imported commodity. Yeah. So somebody has to bear the burden. So only three players are there. One is the government, second is the oil marketing company, third is the consumer like us. So either one has to bear the burden of it. If crude oil goes to $120 means naturally petrol price will go to 140, 150 rupees, which will be highly unaffordable to many of them, and it will be highly inflationary also. So we don't know what will happen if crude oil goes to $120, $130. This is the price we have seen previously. It is not a new price. In 2014, and all the crude oil was around $110. We have seen that price $110, $115, and the government enjoyed the very low crude oil prices in the last 5-6 years. So that dream period was over now, and we have to see how the government is going to tackle this crude oil price increase. So the next question coming is, will crude oil sustain at $100? Very unlikely. Maybe because of temporary geopolitical reason, the crude oil may go there. It won't stay there because the US oil production is already started increasing sharply. The shale oil, because many fields are now commercially viable. Crude oil prices are high. The cost of production of shale oil is high. Intermittently, they reduced the production because of very low crude oil prices. Now the crude oil prices is going up. So they what many US shale companies are doing is that they are again restarting the oil production from the shale fields, which means that the supply will start coming in. And once supply starts coming in means basically the price will start falling. So the above $100 crude oil is unlikely to sustain. It may go there, it may go to $110 or $120 because of geopolitical reason for temporary period of time, but it won't fall for long period because of new oil supply will start coming in. So that is the only positive we can see currently as far as the oil prices are concerned. RBI versus global central banks. Just 2 days back, RBI came out with its policy make. It was a highly divergent views between RBI and global central banks. If you see ECB, there is European Central Bank, US Fed, everyone is highly hawkish. They are talking very negative on inflation and they want to increase the interest rate. Whereas RBI statement was extremely dovish in this uncertain time, and and after the RBI policy, in fact, our market went up because RBI sees that next year inflation will be around 4.5% only. If that is the case, then there won't be any need for a rate hike for our country. Where rate will remain same. Whereas US Fed and ECB were extremely hawkish. There are some comments that RBI will be behind the curve by vast margin, because if crude oil prices goes up and if that price is passed on to the consumer mix, it will be highly inflationary. But RBI is not seeing that risk, and they are giving a super dovish statement. That is what is the view of the economist, and we have to see what will happen in coming days. India cannot remain isolated from the world in this global economy, because everyone is interconnected. And one thing which RBI cannot defend beyond a point is the rupee. Because as a country with current account deficit, we need the investment from foreign countries through FDI, and if RBI doesn't hike rates when everyone is hiking rate, and if inflation is high, means naturally rupee will react very negatively, and rupee will start weakening a lot, and weak rupee will fuel the inflation further. And next 1 to 2 months is going to be crucial, and rupee will initially indicate the stress in our economy. And another one theory that is going on the market, global market, is that there is a huge amount of money in bond market. Now the bond yields have started going up. Many bonds which are having negative yields, they have come into positive now. So whenever the bond yields goes up, means what will happen is that bond investors used to lose a lot of money in bond market. So in order to avoid loss, what they will do is that there is a possibility of shifting money to equities, provided equity valuations are attractive. Now what we are seeing is that equities are correcting, and if there is another 5 to 10% correction in overall global markets, there is a possibility of bond money that may come and support equities. That is a very valid argument, and that may happen if equity valuation corrects, because whenever bond yield goes up, bond investors will make lot of losses in their bond portfolio. And COVID, now no one is talking it, because the Omicron was extremely mild, and most of them got affected. I also got affected last month, and but it was extremely mild. Only 2 days of fever, then another 1 or 2 days of tiredness. That's all. And no one is now looking into it. And many European countries has completely opened up their economy. They have told not even to wear the mask, and all the COVID restriction has been removed. Until new variant comes, I expect we won't have any problem as far as the COVID is concerned. FPI continuously selling, and if you see that in the last decade, this is one of the highest sell year, with almost 10 billion they have sold in their current financial year, and still 1.5 months to go. Until then, if you see in the last 10 years, only in FY16 they have sold 2 billion, and this is the next sell in the last 11 years. And whatever selling is happening, it is getting bought by domestic institutions as well as retail investors. The mutual fund money inflow is very strong. Last year, after record inflows, last month in December, we had a record inflows in mutual fund. In January, it is almost 15,000 crores. A healthy inflows is coming. So overall, on a conclusion basis, now everyone is talking about US rate hike, and equity market will discount you actual rate hike happens. So once rate hike is announced, I feel that market will go up. The March 16th is the US Fed date, and before that, equity and bond markets will discount the rate hike. The one thing which is uncertain is the geopolitical tension. No one knows what will happen. I also don't know how the geopolitical tension will pan up. in coming days. There may be people who are on the corner. They may sell because of geopolitical tension and news. But overall, I don't know how it will pan out. Only time has the answer. And in the next 1 month, we are going to see huge volatility in the market, and the volatility is going to be very extreme, and sector churning will come. Those who have made investments in the consumers, they may try to shift it to other capital goods like that, where the focus is going to be for the next 1 year. Sector churning will happen, and volatility both globally and locally will happen. And here in domestic, government will try to complete the LIC listing before March end. If market is extremely volatile, means we have to see how government will complete it. But government will try to list LIC shares before March end, and many retail investors are very interested to subscribe to it, and record demat accounts are getting opened because of to subscribe to LIC IPO. I feel that retail will bail out the LIC IPO. Even the global markets are very weak. So government will sail it. The only problem with the government is that previously any big issue comes, LIC used to participate in that, and they used to put in a lot of money. But since LIC IPO itself coming, LIC cannot subscribe to that issue. So government will majorly will focus on retail money to get subscribed. And events to watch, foreign flows, then the global markets, we have to see how global markets is going to be. Then the geopolitical tension, which is there between Ukraine and Russia, and that we have to see. Then the LIC IPO. So this is the events to watch. Next 1 month is going to be extremely volatile. Now let us see the recommendations. So this is the recommendation this time I am giving. Last time we gave SBI. So one of the safe space in current environment is being in banks. SBI, ICICI, Axis Bank. These three are major banks, which is one of the safest space considering the current volatility in the market. Last time I gave SBI, and this time I am again giving ICICI Bank. And during the volatile time, it is better to be in safe stocks rather than trying to find a company which will go up by 40% or 50%. And ICICI Bank, we are recommending it. Bank is doing very well, and we expect the NPA recognition cycle is over, and it will thereby the provisions for NPA will be lower in coming quarters. Among pharma companies, we have seen so many pharma companies doing very badly, and Cipla has done relatively better. And even if you see the results, they are doing very well. And Cipla is an ideal stock in a pharmaceutical for long-term play. Garden Reach, we have already recommended many times because of strong order book. The execution has started well, and from here on, the execution will be very good. Yesterday results came, 20% growth in profit was there, and they have announced a dividend also, and the execution likely to pick up very sharply in the next financial year, and we recommend that stock. GNFC, the results has been very good, and their chemical business is doing very well because of high chemical prices, and it's a zero debt company. They don't have any debt, and they have surplus cash, and they're likely to do well for the next 1 to 2 quarters, and thereby we are expecting the stock price to be stable. The last one is the Reddington. This is also a company which used to give very high dividend. The results also has been very good, and one can buy the Reddington. They are basically in business like they are the dealers for Apple, big brand names like Apple, Samsung, Acer. These type of laptops, mobile phones. It is sold by Reddington, and they are doing well, and they used to give good dividend also. So these are the 5 stocks I'm recommending for this, and if you see the review, we have done relatively better. Only TCS has fell by 4%. Buyback is coming, So we still find there is value in TCS, and one can hold the shares. SBI has done well, and if you see that BSC target has been achieved, it has done well. Deepak Fertilizer from our recommended price, our up to our target price, it has gone up by 13%. If you see from our recommended price to a high price, it has gone up very sharply. We recommended by 415, whereas the high price was 659. Almost 50% the price has gone up after we recommended in Deepak Fertilizers. Chemplas Sarma, the research has been good, but price has come down. One can hold it. They are making good profits. They have become net cash, net debt, zero debt company. So this is the review. This is the review. Overall, our portfolio has done 4.5% well, whereas the Nifty has gone down by 2%. Relatively, our portfolio recommended portfolio has done well. Now we will go to Q&A.